Hey guys, welcome back to the Educated Weirdo and Girly Show. First, remember to like and subscribe. Today we're going to be telling you about the three main categories of income, and if you stick around, we'll fill you in on how the rich pay no taxes, so stay tuned. Hey guys, welcome back to the Educated Weirdo and Girly Show. First, remember to like and subscribe. Today we're going to be telling you about the three main categories of income, and if you stick around, we'll fill you in on how the rich pay no taxes, so stay tuned.
This is a lottery ticket. In its current state, it holds no monetary value. But yet, a lot of people buy it in hopes that one day it will. This is nothing more than a poor man's 401k plan. Sadly, throughout America, a lot of people turn to these facets because they're just tired of the normal 9-to-5 day-to-day monotony, and this gives them a glimpse of hope. As kids, we're often taught the traditional 9-to-5 route. A lot of us are unaware that there actually are three main categories of income. Most people are only familiar with earned income, which is also known as active income. Earned income is income earned in exchange for doing work for someone else. Some examples consist of hourly wages as an employee, salary wages as an employee, hourly consulting for companies. All of these are different examples of earned income, better known as active income. This is what we're taught as kids is the most effective way to earn income. A lot of times, if this isn't, we are taught to multiply this. So get 2 jobs, 3 jobs, just step up our efforts. A lot of us are unaware that there actually are 2 other categories of income, and we will cover those now. Capital gain income, also known as portfolio income, is income made from the sale of appreciating assets. For example, buying a stock at one price and selling it later at a higher price. Purchasing a home, then selling it a year or 2 later once it appreciates in value. One simple way to remember capital gains income is to put it in an equation format. Capital gains equals selling price minus purchase price. Day traders and swing traders often take advantage of the volatility in the stock market in order to generate capital gains. By doing so, they are able to acquire massive wealth in a short period of time. Third category is going to be passive income. Passive income is income earned from assets that require no work on your part. Examples of this are such: dividend-paying stocks, rental income, REITs, which is an acronym for Real Estate Investment Trust, royalties from patents or copyrights. These are just a few examples of generating passive income. There are a plethora of ways of doing it. In fact, if I had to go back in time, I would put a lot of resources and time into passive income. You really need a combination of all three. Okay, you guys, as promised, I went through the 3 different categories of income. And also as promised, I'm going to tackle how the rich, wealthy, and savvy continue to not pay taxes year after year. And eventually one day you can use these same tactics and not pay taxes. So let's get into it. Okay, you guys, before we jump in feet first, got a question for you guys. Out of the 3 different categories of income we just covered, which one do you think actually pay the highest taxes? Yeah, you guessed it. Earned income. Out of the 3 categories, earned income is the highest tax category. Coincidentally, that is the category that they teach everyone as a kid, that you must go into the active or the earned income. But Meanwhile, capital gains and portfolio actually pay a lot less taxes, and passive income pay a lot less taxes than the active day-to-day work. Just a little something to make you guys think. So, how does the rich, wealthy, and savvy not pay taxes? I'll tell you how. They put most of their money, time, and resources into real estate. And let me explain. I'm going to take you through a few scenarios. I'm going to teach you some new words and different verbiage of such. And by the end, you will be fully, let's scale that back. You'll be somewhat acclimated with how they do it, because there's plethora of different ways to do it. But let's get right into it. In real estate, you can write off expenses in relation to your business. So, for example, let's say you had a property that's $100,000. Okay, and you rent that property out for $1,000 a month. Keep the math simple, that's $12,000 a year. All right, now let's say your expenses are $2,000 for your property manager expenses, $2,000 for the interest, $3,000 because you had to replace your HVAC unit, and let's say another $105,000 for miscellaneous expenses. Okay, when you minus all your expenses out from the $12,000 gross for that month, that leaves you with $3,500 taxable income. Now, of course, in real life, they would have bukus of properties, so you would have to take that $3,500 and multiply that by 10 or 20, just depends on how many different properties they actually had. But to keep it simple, we're just going to say we're going to use one house as the example. So you have $3,500 taxable income that you owe on that particular property. Or do you really owe that on the property? Remember, we're doing zero taxes here, so the goal is to get to zero taxes. So one slick way to do this is what's known as depreciation. You see, the IRS allows you to write off a certain portion of your actual value of your house. Okay, and the way they do this is they say your house basically depreciates over a course of 27.5 years. So to keep the math simple, because we're talking about a $100,000 house here, you would take $100,000 and divide it by 27.5. That actually gives you 36. So 3,636 is the math on that. So if you go back and you look at what we stated earlier, you have net total of 3,500. So if I have a net total taxable income of 3,500, but I'm allowed to write off $3,636, I pay no taxes, my friends. And that's one of the many ways that they do not pay taxes. Okay, but hey, I know what you're thinking. What about the extra money that they make from the rental properties appreciating in value over the years? Surely they pay taxes on that. Ha ha ha, my friend. Well, not necessarily. This is what's known as unrealized gain. So, simply put it, the IRS allows you to not be taxed on the appreciation until you actually sell the property. In most cases, most people would refer to this as common sense. But hey, since we're educating you guys today, we'll cover this as well. So once I actually sell the property, this is when I actually would pay taxes on the appreciated value over the years. Which brings me into my next topic, which is going to be the 1031 exchange. So when you sell a property, let's say the property costs $100,000 and over the years it appreciated $200,000. So when I actually sell the property for $200,000, there is a $100,000 realized gain at that point, and it's actually taxable. So you're probably thinking like, ha ha ha. So they actually do get taxed at some point, educated weirdo. Not necessarily, my friend. With the 1031 exchange, the IRS has given you the green light to actually take the proceeds from the sale of real estate and actually transfer that over into another real estate venture and pay absolutely nothing. In fact, this is so powerful, you can do this over and over and over indefinitely until the day that you die. And then the day that you die, you can take that and pass it along to your kids as inheritance. And because you pass it along to them in that fashion, they pay absolutely no taxes on it also, my friend. And this is how the rich stay rich and pay absolutely no taxes.